Yeah, so I'll just kind of go over general market update. I there wasn't too much to update this week from a crypto equity perspective or kind of a Bitcoin price structure perspective either. Both are just kind of going sideways, drifting downwards. So on the general market update, macro front, obviously it was a shortened trading week with President's Day on Monday in the U.S. But there's still a lot of interesting things that happened. So I wanted to start off talking about Fed minutes, which came out on Wednesday. So for those who don't know, Fed minutes just kind of give you a behind the scenes look into what Fed officials are discussing, behind closed doors, um, to an extent. So I what I thought was interesting is we're kind of seeing this market play out the way that we predicted in our 2023 market outlook. So if you're a consistent reader of Blockware Intelligence, kind of the result of a lot of the things that I'm going to discuss here, are kind of exactly what we were talking about, back in November, December. But Fed minutes indicated that there was a unanimous vote to raise 25 basis points, but there were a couple officials who were, voicing support for 50 basis points. But it kind of, when taken into the context of all the other things that we're going to discuss today, it really just reinforces the Fed's conviction to raise rates even higher than initially expected and to hold them elevated for longer. So this morning we got January's PCE numbers. That's the personal consumption expenditures index, which is fairly similar to CPI, but CPI is looking at the prices of finished goods, while PCE is looking at how much people actually ended up spending on goods. The thing to really just know with PCE this morning was that the numbers kind of came in hotter than expected across the board. On a month over month basis, core PCE, which is PCE minus food and energy, rose 0.6% in January, which was a fairly high reading for the month over month change. In fact, going back to the great inflation of the 70s and 80s, this morning's number was the fourth highest reading since 1984, which I thought was pretty interesting. And the only other times that we've seen core PCE surpass 0.4% month over month, excluding the 70s and 80s, were 1990, 2001, 2007, 2009, and then we've seen it fairly consistently from 2021 until now. Um, I'm sure a lot of you guys know this, but core PC is the Fed's favorite inflation metric. So obviously, seeing it come in hotter than expected. I want to say it came in hotter than expected for December too. I could be wrong. Don't quote me, but obviously, seeing them come in hotter than expected just kind of adds more evidence to that idea that the Fed is going to need to raise rates higher for longer. And like I mentioned, that's something that we were discussing fairly in depth in our 2023 market forecast. And if that's something that you haven't read, definitely be sure to go check that out. There's a link to it in the newsletter in the general market update section. But based on February's FOMC minutes and also that the PCE data just discussed, it appears that the path forward for monetary policy is raising rates above that initially expected 5%, and then holding them there for the majority of 2023. And currently this is what's going on in the market is just the market trying to catch up to this new data. So if we look at the Fed watch tool, we see that the market's now pricing in a roughly 70% chance of us getting a 25 basis point hike on March 22nd. Then it's also pricing in 25 basis point hikes in May and June as well. There's also a fairly significant chance or probability that the market sees of the Fed going for 50 basis points in March. It's about a 30% probability. So at the moment, based on all that, the market is believing that the Fed's going to hold rates at 5.25% before pivoting in December. Obviously, a ton can change between now and December and will change between now and December. But based off of current Fed posturing, on February 24th, this appears to be the most likely scenario for the market. So obviously, when you have future interest rates rising, or the interest rate in the future is expected to be higher than initially expected, you're going to see Treasury yields rising in accordance. So as of right now, the 2 year sits at about 4.83%, which is fairly close to that cycle high back in November, which was right around 5%. So the 2 year is considered to be the most policy sensitive Treasury, and it kind of works as a de facto terminal rate estimate. So whatever the the 2-year yield peaks at in a specific cycle. That's generally ballpark what the market is expecting the Fed funds rate to peak at the peak of the hike cycle. So back in November, it was right around 5%, which is indicating the market thinks the Fed funds rate will get to around 5%. But now with the market shifting, I wouldn't be surprised to see the 2-year yield make a new cycle high and get into that 5.25% range. We've also kind of seen a rebound in yield spreads, which I think is really interesting. So when we compare the yield between a short maturity and a longer maturity bond, it gives us an indication of a lot of different things. But generally speaking, we're just looking at the level of risk that smart money investors, if you will, see between the short term versus the long term. So these yield spreads have been declining, fairly quickly over the course of 2022 into 2023. Now we're kind of getting a bounce, which is indicating to me at least that the market is now more concerned about that longer term interest rate risk. What I also think is interesting is obviously, I'm sure a lot of you guys have heard, is when you see like the 2 to 10 year spread, for example, or the 3-month to 10 year spread flip negative, it tends to be a very accurate recession indicator. What I think is a little more interesting is that you tend to see the recession kind of align closer with once the yield spread is flipped negative and then crosses back above zero into the positives. That tends to align a little bit closer with recession timing. Obviously, there's a lot of variation there. In 2001, it was like a month later after the 3-month to 10-year spread flipped positive, there was recession declared in the U.S. But in 1990, it was like a year, and it's been even longer than a year in the past. So it doesn't necessarily mean that you need to go convert all your money into gold or buy Bitcoin. It just means that we're potentially moving in that direction. But of course, a lot could change. So, with that, yesterday morning we had the advanced Q4 real GDP estimate released. So, for those who aren't aware, GDP numbers are just estimates because it's essentially impossible to measure every single penny of economic output across a really large advanced economy like the United States. So they release estimates. So initially they'll release an advanced estimate, then they're going to revise that a couple more times later on as more data comes in from that previous quarter. So on January 26th is when the BEA released that advanced estimate, which was 2.9%. Yesterday, it was revised down to 2.7%, which is mostly following changes to PCE inflation and consumer spending numbers. So actually, like nominal GDP was adjusted upwards, but because Q4 PCE inflation numbers were revised also upwards, real GDP was actually adjusted down. It's nothing. It's not a huge market mover. We're talking about economic data from several months ago now. Going all the way back to October. But I think the fact that the BEA believes that economic growth is not increasing as fast as they initially thought is potentially a cause for concern. But like I said, this is past looking data and isn't really aligned with markets who are forward looking. I also talked about mortgages in the housing market a bit in the newsletter. I'm not going to dive too in depth into that here, but mortgage application numbers. So we look at the MBA's purchase index, which is looking at mortgage application volume, was down 18% to 147, which is the lowest value that this index has seen since 1995, which means that according to the Mortgage Brokers Association, there were more people trying to finance home purchases in the depths of 2008 than are today, which I found pretty interesting. From there, we kind of talk about mortgage delinquencies. Looking at the stock market, I mean, there's not anything horribly crazy to go on. Obviously, we're starting to roll over here. The Nasdaq is, I want to say, sitting right around its 200-day. Oh, just undercut the 200-day today. The 50 days. Not too far away below. I think the 50-day kind of makes a probable support zone for the Nasdaq, but definitely something to keep an eye on for the rest of the session. But that pretty much sums up everything I talked about for the macro. Like I mentioned, there wasn't a ton to update for crypto exposed equities or for Bitcoin price action. Bitcoin's kind of breaking down below the 21-day here today. That's a pretty key zone. I would like to see a reversal here today, but who knows? But we're kind of just floating around this 21.5 to 25,000 zone, and I kind of see us doing that for some time now, just kind of wearing out the bulls and the bears before we can make a sizable move in any direction. So yeah, that's about it. Do you guys have any questions or topics you want to discuss more?
Yeah, I got a few points here, and we don't have a whole lot of time. We got a lot to cover still, so we don't have to spend too much time on it. But one thing I was thinking about, and I'm curious what you think on this topic, Blake, is traditionally you've got like your 60-40 portfolio, right? Bonds and stocks. If I'm understanding right, they're supposed to have an inverse relationship, right? So you'd see stocks go down, and then you'd see bonds get a bid, so yields would go down. But now we see yields go up and stocks sell off at the same time. So where is this capital going? Are people just selling to flee into dollars, or what's going on here, Blake?
Yeah, I mean, I would imagine there's a lot of cash reserves. There's also there's been a pretty large influx into equities, and you saw the price action of the stock indexes over the course of 2023 until basically this week. What I do think is interesting is, and to your point, Mitch, is 2023 has been one of the weirdest periods for price action in the sense that there's a huge discrepancy between what yields are doing and what stocks are doing. I can't remember the exact number off the top of my head, but I was looking at this chart yesterday and it was showing that the correlation coefficient between the equity indexes and yields is at its lowest since 2020. So in 2020, you saw the bond market selling off, and fears about the pandemic, and then stocks were ripping higher. There was that big discrepancy there, and now the market's kind of right back to those levels of the stock market and the bond market are kind of just doing their own things. That being said, generally the bond market tends to be right. 2020 was kind of a unique period there, where no one really knew what was going on across the globe. But generally speaking, we saw this a lot in 2022 as well, where it'd be like yields would roll over, start heading, dipping back lower, and then stocks would take a little bit to catch up and start going higher. But it's interesting. I think with yields spiking the way they are right now, headed towards all-time highs, I just don't see how the stock market can ignore that. That's kind of something that we're seeing today. Obviously, yields are up pretty big today. Bitcoin's rolling over. Risk assets are kind of rolling over. So not really too much of a shock. And that's something that we've been talking about in the newsletter for the last, I don't know, month. Is eventually yields are or stocks are in risk assets are going to catch up to yields. It's most likely scenario, and that's kind of what we're getting this week.
Yeah, that makes a lot of sense. Blake, I think that was great analysis overall. I'm curious, you mentioned, the future expected rate hikes in the Fed funds rate. When is the Fed funds, or do you know when is the Fed funds expected to peak? And like, does this moment, whenever that does happen, does that mean anything, at least in hindsight, or not?
Yeah, good question. So we talked about this a little bit in the newsletter, but um, based off of the current Fed Watch tool, which is aggregating Fed futures data by CME Group, the market is currently expecting the last hike to take place in June. Um, and obviously, these are probabilities, so nothing is guaranteed by any means. But at the moment, it appears that the market believes rates will peak in June and be held at 5.25% until December or so, when rates are expected to be brought back lower. That being said, I mean that's going to be a long period of time, right? With rates held at historical, very high values. Obviously coming from zero, going from 0 to 5.25 is a really big jump, and it's even bigger than like in the 80s when you were seeing these massive increases to the Fed funds rate, but they were going from like 10% to 16% or something like that. So as a percentage of a percentage, which is maybe a math sin, but we're seeing rates jump even more aggressively in this period, and I think it's going to create issues in the market when rates are just held there for the foreseeable future, for however many months that is, 6 months. And it's something I also mentioned in the newsletter when we were talking about mortgage delinquencies. So a delinquency occurs when someone doesn't make a payment on the loan for 30 days. A foreclosure occurs when you've been delinquent for 120 days. Delinquencies are still declining. So we're not really seeing people unable to make their interest payments, but it's likely to happen. I would say extremely likely to start rising in 2023. In like 2007, 2008, we saw delinquencies rise from about 2%, which is roughly where they're at right now. They rose all the way up to like 11.5% by 2008, 2009. I don't obviously who knows, to what extent delinquencies could rise this year, but I would expect to see them start to kind of curl upwards because they've been on this downward trajectory basically since the housing crisis.
That's interesting. I wonder how many of those mortgages are variable rates, because I know that was a big reason for why 2008 was so bad.
Yeah, definitely. I couldn't tell you off the top of my head, but that's definitely something to look into.
One thing you had mentioned, or at least Joe had tweeted this before, and when you were talking about core PCE, being higher than expected, it made me think of Joe's tweet from a while back, which was like, "Oh, you sold your Bitcoin because inflation is too high." And it's just weird how the markets respond to things, because they are forward looking, right? But inflation, okay, it comes in higher than expected, right? But then it causes people to sell off their hard assets. Obviously it's because it's expecting future rate hikes, but it is just weird how the fiat system responds like that.
Yeah, definitely. I mean that, and it's exactly what you just said. We're expecting higher future rates, which means there's a larger opportunity cost to buy and hold bonds. So you're going to see bond yields rising in accordance, and then bond yields are used to price a lot of different assets. So when the bond yield is rising, that's increasing the discount rate that a lot of banks and institutions like to use to value stocks. So the current value of stocks is falling, which causes a sell off. So it's kind of this massive chain reaction. But yeah, it kind of all starts with, in this sort of environment, it's starting with inflation not coming down at the pace that most people were expecting, which in turn incentivizes the Fed to raise rates even higher.
One thing I heard, I think it was Preston Pish on a podcast this week, and this will segue nice into the Bitcoin section, was that higher rates, yeah, they're gonna affect companies, right? Because they have to make higher interest payments, and they're gonna be less profitable. But Bitcoin isn't a company, and we have seen this, or we've already seen like a huge capitulation. We have seen markets tank a lot, and yeah, sure, equities could go further, but the higher rates aren't going to affect Bitcoin as much, you would think, because it isn't a company. But and that's sort of why I looked at one chart this week, was the correlation between Bitcoin and the S&P 500, and it has flipped negative for the first time since the FTX collapse. And it's short term, but it's definitely something to keep an eye on. And that is an interesting thought. Like, hey, Bitcoin doesn't have to make interest payments, so rates going up doesn't really affect it. It only affects how people, that are trading it respond.
Yeah, and I'll touch on that real quick before you can get into some of the on-chain stuff. But yeah, you're right. Obviously, interest rates don't have a direct effect on the Bitcoin protocol. There's a little bit of effect on the network in terms of mining and things like that. But the one thing to keep in mind is stocks aren't going to sell off with increasing interest rates just because the companies are going to perform worse. It's because companies are going to perform worse, which causes people to sell the stock. So in this kind of environment where you have rising interest rates and thus rising yields causing people to sell stocks, it just creates a lot of fear in the market. And obviously, Bitcoin is treated as a risk asset in this sense. So even though higher interest rates don't have this direct effect on Bitcoin or supply issuance or anything like that, it does just create fear of owning risk assets and decreased risk appetite, which in turn causes a sell off in Bitcoin.
Definitely. I hope hopefully the fear subsides as more people are educated on Bitcoin. With that, we can go into the on chain. So the first, let me pin up my thread real quick so everybody can see what I'm talking about. But the first chart I looked at, it's the first chart I look at every week recently, is the realized price, short-term holders, and then just the aggregate market realized price. And they're smack even now. Short-term holder realized price is basically gonna take over realized price any day now, which has historically signaled the end of bear markets. So that's a huge milestone that I've been looking at throughout the whole bear market, and this has finally happened, which gives me confidence that Bitcoin won't make newer lows. But of course, anything could happen. The long-term holders, they continue to accumulate. I'm going to look at this one every week probably until we see them start to sell off, and it just hasn't happened yet, right? And basically the theme of this newsletter, and it's been the theme for the past couple of weeks now, is on-chain long-term holders are still accumulating. So that's supply that's getting sucked up to entities that are very unlikely to sell. And we're seeing demand slowly trickle back into the market. We haven't seen and we won't see a massive shift in demand overnight. We won't see a bunch of new people flooding back in. But over time, as price stays above where it was in November at the lows, we will see more people trickle back in, and that's what we're seeing when you look at new addresses specifically. It's really taking off here in the last few months. The stablecoin supply ratio, this can give us some short-term signals. So typically when it hits the upper Bollinger Band, which it has, that signifies like a local top. Basically, what the stablecoin supply ratio measures is the amount of stablecoin purchasing power relative to Bitcoin. So when it hits that upper Bollinger Band, that means a lot of stablecoins relatively were deployed recently. But in the long term, you do see this metric go down, and that's because the stablecoin market is growing. Obviously, stablecoin's not Bitcoin. They don't have a limited supply. They tend to be, there's trust in a third party there, but it does allow for borderless, friction-free payments. And so, seeing demand for stablecoins increase, to me, that's bullish for Bitcoin, right? Because in my mind, a stable coin is a lot more likely to be deployed into Bitcoin during a bull run than just a regular fiat dollar. So, these stable coins are really only one step away from being converted into Bitcoin. And right now, we do see, it's at the top of the Bollinger Band, so maybe the price is overheated a little bit. And we have, this week we've seen it start to trickle back down. But in the long run, seeing the stablecoin market grow is not a bad thing. And then the next chart I looked at, I tweeted this a few days ago, was the number of addresses with a balance greater than $10. There's not really a short-term signal here, but it does show you how adoption's been going throughout this bear market, right? So when you think of if an address has a balance greater than $10, there's two functions there, right? There's obviously the price of Bitcoin affecting the balance of the address, and then there's this is the number. So as more coins get split up, as more people enter the market and start buying, that number of addresses with a balance greater than $10 is going to go up. And so we've seen it basically go sideways since the peak in May of 2021, which while the price has gone down, this has stayed flat relatively. So that's the new people coming in and buying Bitcoin. The supply is getting distributed. This shows adoption, and in past bear markets, you've seen this go down from the peak, but right now, basically adoption has happened regardless of the fact that there's a bear market. So that's very bullish. People are finally realizing, hey, like Bitcoin's not dead this time. Sure, it's down. It went down, 75% from the high, but I think people intuitively know that one day it is going to come back. Definitely people in this space, but I think even traditional markets are sort of starting to get that feeling, even if they won't admit it. And then another thing I looked at was the ordinals. So when you look at the mean block size, it spiked with the rise in popularity of ordinals and inscriptions, but it is starting to revert back to the mean slowly. And same with Taproot adoption / utilization, that spiked tremendously, but it's come crashing back down. So it does appear that ordinals were definitely sort of just a temporary fad, and yeah, I'm not really surprised there. Over the long run, we probably will see Taproot adoption and utilization continue what the trend it was on before, which was just a slow, gradual increase as non-ordinal use cases are being developed on Taproot, like certain multi-sig stuff. And I would expect during a bull market, if there's two cases here, right? Fees are going to be higher in a bull market, so you might not see the inscriptions and stuff come back like they did recently. But then again, you could see, as bull markets bring new waves of speculators, perhaps there's going to be some people wanting to inscribe NFTs and stuff onto the blockchain. So there's definitely two trains of thought there. And then the last thing I looked at was the futures funding rate and open interest relative to market cap. If you've been reading the newsletter consistently, you know that during sideways price action, you do see a buildup in open interest in the perpetual futures market. So because perpetual means they're futures contracts that don't have an expiration date. So when the price goes sideways, there's fewer liquidations of shorts or longs. So you do see a buildup And basically, that's why the longer Bitcoin moves sideways, the next move of volatility is going to be nastier because there'll be more longs getting liquidated or shorts, depending on which way the price moves. But overall, funding is still positive, but it does appear to be going down slightly as price goes down, but nothing significant in the derivatives market this week.
Nice, great analysis, Mitch. I was looking at the first chart that you posted in the newsletter comparing realized price and short-term hodler realized price. And I was curious if you know, has there ever been like a bear market in Bitcoin's history where the short-term hodler realized price dropped below the realized price? And then as you talked about, it's basically about to go back above the realized price. Has there ever been a bear market where once this occurred, Bitcoin made new lows, or would that, if that does happen, would that be one of the first times ever?
Yeah, good question, Joe. That would be the first time that has not happened before. So, this cross, you can call this a bull cross or whatever you want to call it. But when short-term holder realized price goes back above realized price, it has historically signaled that the low is in. So that's why I've been looking at this metric consistently the past few months, because now it's finally happened. And to me, I think I'm gonna call the bottom. Obviously, that's my opinion. That's not financial advice. So don't go out and go long and set your liquidation price at 16,000. But I personally think, unless, and I think this is a lot of people's concern, would be a black swan in macro causing a massive sell off. To me, that's the only scenario in which the price would drop back below the low. But yeah, I don't think that's guaranteed to happen.
Yeah, Mitch, I agree with you. I feel like there's a lot of on-chain headwinds that are indicating that we could very well see prices continue higher in the near term. But like you mentioned, a lot of it just depends on the macro situation, and it's similar to what we were talking about earlier, where Bitcoin is treated as a risk asset right now, whether you like it or not. So if rates are going to continue higher, if rates are going to end up higher than they are right now, or than they're currently expected to be right now, there's just a million scenarios that create these macro headwinds that could really hurt Bitcoin price action in the near term. But obviously, who knows what's going to happen. I do think it is encouraging, though, from an on-chain perspective, to see some of the bullish developments that are underway.
Yeah, certainly. Yeah. At the end of the day, with Bitcoin, it is just a function of supply and demand, right? The long-term holders they're going to continue to accumulate supply until we get, sort of pushing new all-time highs. At that point, you'll see them sort of, start to distribute into strength. But, this 50% rally didn't phase them. The hodlers are still going to accumulate. And, eventually there's not really going to be anybody to sell Bitcoin other than the miners. And it feels like we're already sort of at that point.
Yeah, I agree with both of you guys there. I had another question relating to the stablecoin supply ratio. I guess you made some great points about, hey, the amount of stable coins relative to the total market value of Bitcoin is, I guess, at this point kind of low, meaning, the value of Bitcoin's pretty high and there's, I guess, not that many stable coins on the market or just available to be deployed into Bitcoin. Let me know if I'm interpreting that wrong or
Yeah, no, I think you got it. I want to clarify.
yeah.
So it's at the top of the Bollinger Band, right? So that's the 200-day moving average plus 2 standard deviations. So relative to recent times, the buying power is down, but the chart's kind of wonky, so the ratio's inverted. When this goes down, that's stablecoin buying power increasing relative to Bitcoin. So you see the stablecoin market cap growing, but recently at the top of the Bollinger Band, yeah, that was stable coins that were deployed into Bitcoin, and now relative to the past 200 days, buying power is down, but the long-term trend is stable coin buying power is up.
Gotcha. Yeah, that makes sense. I guess part of my question relating to that was, does that mean that, I guess, it could mean like the price of Bitcoin is going up and like the amount of stable coins is going down, or could it mean simply that maybe the total market value of stable coins is just kind of going down and people are potentially trusting them less? I don't know. I haven't looked at the stable coin market too much.
That is a good point, and something I hadn't considered, and that very likely could be the case. is that there's diminishing trust in stablecoins given the uncertainty around regulations.
Cool. Yeah, I was just curious.
Yeah, I'll look into that for the next week's newsletter. That's a good point, Joe.
Appreciate it. Yeah, I guess I can transition into Bitcoin mining, unless you guys have any other questions or topics.
Go for
Sweet.
it. Jinx.
There are, I think, 3 or 4 topics that I covered in the newsletter this week. The first one is this upcoming projected difficulty increase. So later today, in a few hours, mining difficulty is projected to go up about 10% at this point. And obviously, for Bitcoin miners that exist today, it's obviously not the best thing. When mining difficulty goes up, Bitcoin miners earn less Bitcoin for the same amount of hash rate they're providing on the network. And this is interesting because, previously we've talked about we expect the growth rate of mining difficulty to be slower than in previous years, and yet we're about to see this pretty significant difficulty increase. And I think there's a few potential reasons why we're seeing this significant increase in difficulty today. The first reason is newly manufactured XPs and J Pro Pluses are getting plugged in. So these are Bitmain's top of the line machines that you've seen public miners acquiring, you've seen private miners acquiring, and you've seen retail miners acquiring these machines. These machines have, over 100 terahash in hash rate, and they're actively and constantly getting plugged in and onboarded to the network. The second reason that I think we're seeing this significant difficulty increase is we have winter ending in North America. Global energy prices are retreating, from their highs, and mining curtailment is occurring less. And so curtailment happens when, energy prices are high and miners are like, okay, we need to turn off our rigs because it's simply either not profitable, or they're enrolled in some sort of demand response program where the utility or the grid encourages them or tells them to turn off their rigs. And so now that winter is ending and energy prices are cheaper, generally speaking, miners don't have to turn off as much, and they can simply be mining Bitcoin with fairly inexpensive energy. But with all of that said, with those 2 reasons for the projected difficulty increase that we're expected to see later today, we still expect the month-over-month growth rate for mining difficulty to continue to slow. We don't expect it to surpass previous highs, and we think our thesis of slower difficulty growth will likely remain intact, just due to the law of large numbers, the commoditization of ASICs, and the amount of mining infrastructure that needs to be built out to really make difficulty soar to levels or soar at the rate that we've seen in the past. The second key topic in the newsletter was talking about the mempool. And so for those that don't know, the Bitcoin mempool is basically where pending Bitcoin transactions wait to be included in a block. And as you guys may or may not know, Bitcoin has something called the block weight limit, which limits the amount of data that can be fit in each Bitcoin block. And so miners are going to include transactions that pay the highest fee per the amount of data that they're using to be included in the block. And miners are going to just most likely pick whichever transactions are paying them the most for that space. And so with the whole ordinals thing that's been going on over the past few weeks, we saw the mempool soar in the amount of pending transactions waiting to be added to the Bitcoin blockchain. And we're actually seeing, as of last night, we saw the mempool get very close to completely clearing and being empty. This means at that time, or which will happen potentially this weekend, there will be no or very little pending transactions in the mempool, which means miners won't have, may not be able to have a full block as far as like the block size. And so, like Mitch pointed out, this is kind of more evidence that the hype around ordinals appears to be fading away, at least in the short term. The third topic in the newsletter was energy gravity. I like to cover this every week because I think it incorporates the mining industry into the Bitcoin industry, and as far as like, hey, what's going on with the Bitcoin price. And so for those that don't know, energy gravity is a metric that determines or estimates the break-even electricity price for a modern Bitcoin ASIC. And the general idea is, hey, if miners are able to convert $1 of energy into $10 or so or more of Bitcoin, then that's probably a sign that the price of Bitcoin is overheated and the price will likely correct back towards its cost of production. Of course, Bitcoin is very unique in that we have something called the difficulty adjustment, which means the cost of production will actually adjust towards the price. And so when this happens and miners are converting, $1 of energy into $10 of Bitcoin, we see these two prices inevitably converge in the long run. We'll likely see the price of Bitcoin come down, and we'll likely see the cost of production go up. And that's kind of what has happened. It happened in 2013, it happened in 2017, happened in 2021 and early 2022. And now we're kind of in a period where the price of Bitcoin is pretty in line with the cost of production, and most miners are still just squeaking by. It's been a lot better than it was back in November when the price of Bitcoin was around 16, 17K, but it's still real. And you can look at the chart in the newsletter. The price of Bitcoin is still relatively close to the cost of production, which basically means there's more upside for both the price of Bitcoin and there's upside for miner cash flows. The very last topic that I wanted to mention was on the Blockware Intelligence podcast this week, which you can find on YouTube. You can also find on Spotify or Apple Podcasts. We talked to the co-founder and executive chairman of CleanSpark, one of the largest Bitcoin mining companies in the world, public Bitcoin mining companies. It was a great episode. We talked a lot about Bitcoin mining in the state of Georgia. We talked about CleanSpark buying 20,000 new S19j Pro Pluses, which is the most recent machine that Bitcoin released. And we also talked a lot about energy and energy markets. So I think it was a great episode. I encourage you, if you're not subscribed to the podcast, check it out. Subscribe, like it, and yeah, let us know your thoughts. I think that's it for the mining section this week. Let me know if you guys have any thoughts or questions.
Yeah, Joe. I kind of want to talk a little bit more about hash and difficulty rising here. I'm curious what you think, if any, the halving next year might be playing a role in that. Like, do you think that it's potentially the ASIC market pricing in the halving, people looking to get hash online while rig prices are still low and the block subsidies high, or do you think it's still too far out to have a major effect on the market? I'm just curious, what role halving might have in difficulty rising.
Yeah, it's a great question. I definitely think a lot of miners and people, investors in the space, should be very aware that the 2024 halving is coming up. A little more than a year away at this point, but it is coming. And yeah, I mean, I definitely think, as I talked with the CleanSpark co-founder yesterday, or we released it yesterday, he was, very aware of the halving. He was like, hey, we need to be, as a company, we need to be prepared for this because that is when the block subsidy will get cut in half, which, excluding transaction fees, that's their, basically all of their revenue is getting cut in half. And so miners definitely need to be considering this, especially when evaluating, machines and locking into power purchase agreements. They need to make sure they're running efficient machines, and they need to make sure they have low enough energy rates to where when this halving does occur, if the price of Bitcoin isn't, significantly higher from where it is today, a lot of people, or a fair percentage of miners, could get knocked out of the market. And so, yeah, I definitely think that's something that people need to be thinking about. And yeah, I think it's probably is having an effect on lower ASIC prices than they would be. Obviously, if the halving is further out, and I definitely think it's people are probably putting more and more premium on something like the S19 XPs, where you're going to be a lot more certain that you're going to be able to survive this halving and still generate positive cash flows, even if the price of Bitcoin doesn't go up significantly from where it's at today.
That's a great point of conversation right there, because the way I'm thinking about the halving is it's similar to preparing for a bear market, right? The most successful miners this bear market prepared ahead of time, and at least with the halving, you know it's coming, right? You don't exactly know when a bear market's coming, but you sort of you got to build the house before the storm comes, right? You got to prepare now, because if you're a miner and you don't prepare at all for the halving, you probably won't make it, because basically the price of Bitcoin has to double quickly for miners to be earning the same dollar denominated revenue. And of course, we all know typically halvings are a bullish catalyst, but that doesn't occur overnight. So miners that you're gonna have to endure cut revenue for a little while, and the strong ones will survive and they'll benefit as other miners are forced offline. But you don't want to be the one that has to capitulate at the halving.
Yeah, exactly. I think you made a great point at the end that the strongest miners typically welcome minor capitulations, whether that's from price crashing or difficulty adjustments going up or Bitcoin halvings. Right, when other miners capitulate, that's their competition that's getting wiped out, and when their competition gets wiped out, difficulty then adjusts downward, and then that miner starts earning more Bitcoin for the exact same amount of hash rate. And so, yeah, I think the Bitcoin network is like a self-balancing force where if weak miners do get knocked out, the stronger miners benefit more.
100%. And the Clean Spark specifically, they did a good job, and Matthew talked about that in the podcast, preparing for the bear market. So taking sort of some of those ideas, preparing for a bear market, you might want to prepare in a similar way for the halving. And if you're interested in mining, definitely worth checking out that pod. If you guys have any more comments, now's your chance.
Yeah, no, I haven't gotten the opportunity to watch the Clean Spark podcast, but I just watched the Iris one, and I think they're both really great insights into the state of mining in 2023, and I think just hearing from those two individuals is really beneficial, because they're kind of the two guys who were selling into strength throughout 2021 and building up cash to a certain extent. So seems like hearing from the relatively more responsible miners is really gives really good insights into kind of what's going on in the market.
Yeah, that's a great point, Blake. And something to think about if you were to invest in a public mine or any company really, you need to understand who's running the company, right? So getting these executives from these huge publicly traded Bitcoin miners on our podcast, I think it's great for us because we can learn, and then it's great for listeners if you were interested in investing in Clean Spark or Iris or any publicly traded miner. You definitely want to hear from the mouths of the executives what their thoughts are on the market, and make sure they've got their head in the right place.
Yeah, 100%. And that's kind of the attitude of management, or the risk aversion of management really is hard to cover up in the financials. So that's why I think it's really important to be looking at the financials of public miners. We just released a report a couple weeks ago now that really dug into the financials. If that's something you're interested in public Bitcoin miners, you can check out my pinned tweet on my account. It's kind of a thread that goes over the report, and then there's a link to the full report there as well. With that, I don't have any other discussion topics. If you guys had anything in mind.
Only closing thought from me. Definitely check out that report that Blake was just talking about. We've definitely got a few other great reports in the queue that we're hoping to release, very soon. So stay subscribed to Blockware. Follow Blockware. Follow Blake, Mitch, me on Twitter, and yeah, let's. If you ever have any questions about Bitcoin, about mining, about macro, feel free to DM us.